Good morning and welcome back to Selling Your Business with David King. I'm David King. I'm the author of Selling Your Business, Begin with the End in Mind. It's available on Amazon. And today I have the pleasure of being joined by Kirk Michie with Candor Advisors. Welcome, Kirk.
Thanks, David. Good to be back.
It is good to have you back, and you're by far the most common guest on my show here, my podcast. You've been on as much. I mean, people are going to think we're kind of like Johnny Carson and Ed McMahon. So if you want to laugh like Ed every time that I say something remotely funny, feel free to do the Ed McMahon.
Can I be Questlove and you be Jimmy Fallon instead?
That might be okay as well. Yeah.
Okay. All right.
So Kirk has over 30 years of experience in mergers and acquisitions. He's worked in investment banking. He's worked in private equity. He's worked as an investment advisor. And today with Candor Advisors, he consults with owners and with businesses that are at the initial stages of exploring their alternatives, and some he sees them through to their exit, to their sale. He's been involved in over 50 M&A transactions, and that may be up to 51 or 52 or 53 based on how current there we go. Keep pumping up those numbers, run up the score. So anyway, Kirk, welcome back. And I want to call upon your years of experience because you've seen the markets go up and down and hot and cold. And today it's April 6th to 2023. And the market is pivoting a bit, and there's a lot of uncertainty, and there's kind of a lot of background noise about, what type of market are we in and where is it going? So let's start with just kind of the past couple of years and where we are today and kind of the state of the union for you today, how you see things. So from 21 to 22 to 23, how would you describe how we've gotten to where we are today?
So it's a great all-encompassing question. And just to backtrack a little bit, we're now right around 60 transactions, couple hundred that I've been involved with one way or another as a buyer and advisor or whatever, but direct involvement, about 60 transactions. We're approaching 1 billion of transactions in the last 2 years as a boutique investment bank. We started out 3 years ago with the idea that we would be referring people to investment banks, helping them build their deal teams, getting them to great M&A lawyers like you, David. And what happened was, people started counting on our combination of advisory skills and transactional experience, and hiring us to, kind of take them through the full process. We still work a lot with other investment banks. We have several deals in market with other banks where we're kind of an outside unpaid consultant on those deals. But so we've got this kind of big, ecosphere, if you will. And what we're seeing, whether it's one of our partners in the Candor Advisors National Network or it's a deal we're working on specifically, is that, coming out of the pandemic, or as the kind of the restrictions of being able to meet, started to lift, there had been a lot of capital raised. So probably $1 trillion plus between venture capital and private equity. There had been about a year where private equity firms were doing more portfolio triage than they were buying companies. They were making sure that their companies were okay in the first year of the lockdown, right? So if they were in hospitality or restaurants or anything like that, they had to really, kind of batten down the hatches, inject more capital. On the other hand, if they were in fitness equipment or things that improved upon the home or furniture or anything like that, the businesses went crazy, right? So, the private equity firms spent most of the balance of 20 and a lot of the early part of 21 working on their portfolio companies, not really buying anything, not wanting to close due diligence over Zoom. They want to do physical inspection. So what happened is all that pent-up capital taken together with the fact that the private equity firms had a ticking clock, meaning, they've typically got around a 3-year investment window where they've committed to their limited partners that they're going to put the money to work. And in many cases, they've charged deal expenses and fees against it, even if they haven't gotten deals done. And so what happened is there's a lot of pressure from their limited partners to get money invested. They had that period of time where they couldn't invest at all or didn't feel comfortable investing remotely. And so they were in a big, big hurry. And so if the combination of being towards the end of their investment period and it being kind of 21, 22 coming out of COVID, lots of private equity money was rushing to the market. And what was happening then was that multiples were high because there was a lot of demand. There were a lot of great companies that hadn't gone to market in the year or two beforehand because they didn't want to sell off of lower earnings numbers, right? So their businesses were improving in many cases, so they could sell at these higher multiples. And what you found was that strategics, companies in the same business as the companies that they were buying, seeking vertical integration or adjacent products and services, were also really, really active, right? And so the private equity firms were bidding up the strategics pricing, and you had, just a wonderful time for selling entrepreneurs to get, high single, even into, mid double digit kind of multiples on their EBITDA. So then get this overheated economy happening in 22, the much talked about and yet to appear recession only happening among the, kind of vest wearing Silicon Valley crowd. Recession didn't happen, inflation was happening, and the Fed starts raising interest rates a lot. Now, we could go down a rabbit hole and talk about what that did to banking and Silicon Valley Bank and Signature Bank and stuff like that. But what it did, if you were in private equity, is it made your cost of capital go way, way up, right? They had plenty of money in their funds to get that invested to pay those higher multiples. They were counting on borrowing at much, much lower rates. So when rates started going up, the senior debt at the bank level, went up by a factor of 2 or 3 times. And then the mezzanine debt went up accordingly, right? So now all of a sudden, to be able to generate the kind of returns they'd promised to their limited partners in these private equity funds, they had to be paying lower multiples for the companies. And so that's created some, I would say, headwinds. I would not say that it has reduced multiples in all areas. A and A plus companies are still going out at the same multiples they were going out at in 21 and 22. There's just fewer of them. And now distinctions are getting made, pretty strong distinctions between an A plus company and a B minus company.
Now you use the terrible R word there, but with the current economic uncertainty and anticipated recession or fears of recession, are you seeing that impact the deal likelihood as well?
Certainly it affects sentiment. It's a great question, David, because so there's no such thing as economic certainty except when you're looking back, right? There's always uncertainty. What has happened here, though, is we've been talking about a recession for 2 years. It has not materialized. GDP keeps growing, and inflation is proving that plenty of people, whether they're at the lower end of the spectrum in terms of their income or the higher end of the spectrum, have enough money to keep bidding prices up, right? So without getting into causes and conditions on all of that, there has been no recession. Now, if you're one of the 15,000 people that got laid off at Facebook last year, you feel like we're in a recession. But understand that Facebook probably hired 150,000 people in the 5 years before that. So if they laid off 15,000, that was 10% of the people that they'd added in the prior 5 years. So it makes great headlines to talk about Meta doing layoffs or Alphabet doing layoffs or Amazon doing layoffs, but they're laying off a fraction of the people they hired in the 2 or 3 years before that. So there's been no real recession, but the upward pressure on interest rates has meant that even with the same levels of net income or transferable economics like adjusted EBITDA, the private equity firms have to pay lower multiples. And that means the strategics are no longer having to pay up to outbid the private equity firms, because the private equity firms are offering either more structure like seller notes, rolled equity, earnouts, other ways to try and not have to borrow as much money to get deals done. And that means that if the strategics can easily finish the transaction with cash on the balance sheet, or kind of their senior debt reserves, they can still outbid the private equity firms pretty easily, and they don't have to go quite as far to do it.
Well, even if the employment numbers have remained strong, and so, there's not the full measure of a recession out there, a lot of people, myself included, have been looking at our 401ks and other investment holdings over the past year plus and said, holy moly, I guess my, retirement horizon's been pushed out. Now, doesn't that impact the deals down the food chain a little bit here when we look at the big boards?
Yeah, absolutely. Great distinction. So the first piece of that is the difference between the stock market and the economy, right? The economy,
Right.
well, stock market should essentially be a leading indicator
Right.
of the underlying economy. What happens is, asset prices move up and down based on fear, greed, and logic tends to be the weakest component in the short run. So the discussion about our impending recession, taken together with higher interest rates, made people kind of not know what was going on. And so what it caused was a lot of uncertainty, and that makes the stock market go down, right? So the stock market went down, and not only that, but stocks and bonds both lost money. That doesn't happen. So most people, or it doesn't happen very often in history. So most people whose 401k balances, even if they were in a 60% stock, 40% bond, kind of set it and forget it allocation, lost on both sides of their portfolio. There was no shock absorption, right? So from a sentiment standpoint, everybody that felt a certain level of, I'm comfortable, I'm wealthy, I'm ahead of plan, I'm a little behind plan, but I'll catch up, going into a bad stock market year like 2022, had more confidence at the beginning of the year than they did at the end of the year. And if, to the extent that that impacted, kind of limited partners and or the buyers of businesses, then very definitely their optimism about the idea that EBITDA in the businesses they were acquiring would continue to grow, as opposed to worrying about recession and taking a harder look at, kind of past periods of growth and would it continue, that piece of sentiment changed. And when the sentiment changes like that, then whatever's happening in the public markets has now affected the private markets, right? And so, absolutely, it has a knock-on effect. And where it really lands hardest is if you had kind of a B company, like kind of edge of the fairway or just into the first cut of the rough, but you would still be able to sell at 7 or 8 times in a frothy or good market, and maybe even 9 times in a really ebullient market. Well, now all of a sudden those companies can still trade, but they're going to trade at 5 or 6 times. They're going to stretch to get 7 times because, if the buyer has to borrow more money or convince its limited partners that business is going to be great for this B kind of grade company, which is perfectly good, right? But it's not blowing out its numbers on growth. Well, then that brings multiples down, right? So there's different guidance that we would give to, a great company with professionalized financials and a good solid growth path and plenty of blue ocean in front of it, than we would a company that's sort of at flat level, or just slightly growing, and could maybe dramatically improve their financials in the next 18 months. So for this guy over here, we say maybe you should wait. For this guy, we say, look, there's plenty of money out there. Lots of competitive tension can happen around selling a business like that.
And are you seeing the markets, the Wall Street impact timing decisions, say, for smaller companies you might work with, the lower in the middle market, closely held, both in terms of, and now are their retirement savings sufficient to kind of get them through and leave enough for the next generation without, Does this impact their timing on a sale when they're looking at what the market is right now and the multiples that you're discussing there?
Yeah, another great question. And I'll tell you, one of the things that we try and counsel founders on before we make a decision with them, and we think of it as a very collaborative decision about first finding your why. What's animating this desire to sell? Is it really retirement, or are you sick of working with like employees? Or you burn out? Do you not want to go through another recession? You know, are you worried that the company can't continue to grow and so you want out? Or does the company need a lot more money to be able to grow much more, and you don't want to put the money in or plow back money in, so you want to, you know, take your chips off the table and let somebody else run it? That's going to define which kind of buyer is best for the business. Got to match up kind of the why with the type of capital. Part of that analysis then also comes down to, okay, if you've decided that assuming the market will hit your number, give you enough, getting to your number is a function of, okay, how much do you need on a net after tax basis from the sale of the business to be able to endow the rest of your life or fund your next adventure? And that has to consider what you have in other investments, what other passive income you might have coming in, what your assumptions are about how much your expenses are going to grow once you've stopped running your company and you're no longer able to run your expenses through your S Corp or your LLC. A really thoughtful, clear-eyed analysis, starting with the expense side, thinking about inflation, and then what investments are likely to produce and matching those up will help you get to not just the number that you need to get, but then set a range between what you need and what you'd like to have, right? And that then informs the decision about, like, when you get the indications of interest and letters of intent and you review them with your transaction advisor, look, you know, the market might not give you what you need, right? You don't get to argue with the market. It's pointless. The market is this big amorphous thing, and you're just this one entrepreneur who's been working for 30 years at your injected and molding business, and the market's only going to give you 5x your EBITDA, right? And that's not enough for you, right? So the decision there is, will 5x ever get bigger, right? Will 5x, like, you know, your transaction advisor ought to be able to look at database information and say, well, in the best of times, businesses like yours sell at, you know, 6 or 6.5 times. So yes, if things were frothier, we might get you another turn and a half. Or, you know, if it's going to take 5 years to get there, do a net present value of what you would get in 5 years if you keep growing the business like that, and say, well, maybe the market's number is just the one I'm going to have to accept right now. The key thing is just not to argue about it. The key thing is to just accept that's where the market is, and I'm either having to grow to another number, and be sure to do a net present value analysis on that to say, is it worth 5 more years, you know, to get another half turn, right? Probably not.
You touched upon this briefly. Is there anything you could add in regards to changes in the deal terms or the process that you're seeing from private equity buyers, strategic buyers?
Yeah, absolutely. So strategics are typically formulaic. They're either all cash buyers or they're cash and some rolled equity. They might do earnouts, but earnouts are usually a relatively small part of the purchase price with the strategic, primarily because strategics are typically going to fold the business into a larger business. And just in practical terms, it's hard to track financials. So a good transaction advisor, unless they feel like they've already gotten enough in the initial cash, is not going to agree to an EBITDA-based earnout unless the company gets to continue to be run independently, right? Because if a strategic rolls the business in and it becomes a business unit and there's not even a separate P&L, well, the P&L is no longer controlled by the entrepreneur who's going to be impacted by the earnout. You're not going to agree to that unless you can kind of ring fence that. So generally speaking, with a strategic, it's either going to be all cash or cash and rolled equity. And again, if there's an earnout, it'll be a small percentage. The private equity folks, on the other hand, love structure, right? And for the founders out there listening to this, think of structure as anything that's not cash up front. So structure takes a bunch of forms. It can be rolled equity. In other words, you retain an interest in your business and you and the financial sponsor play for the second bite of the apple when they sell. It could be a seller note. Like they say, we're going to give you 10 million bucks for the business, but of that 10 million, 6 million is going to be cash up front. 4 million is you take back a note and we'll give you 9% a year interest on that. And you're thinking, wow, that's fantastic. And they say, but we're not going to pay you any cash interest for the first year or two. So it'll just accrete, and we'll pay you down the road, or we'll pay you all of that 9% when we sell, right? So it's important to kind of understand that structure. Or they'll say, we're going to give you X amount in cash up front. We're going to ask you to roll equity. We might ask you to take back a seller note, and we might ask you to take some of the purchase price in an earnout. This is one of the ways financial sponsors like private equity firms can tell you that they're buying your business at a higher multiple or a higher valuation, but not actually pay you that, right? You need to kind of think, as the founder, the seller, you need to think about whether the contingent consideration that you might receive, like what's the risk that you won't get it? And if you don't get it, is the initial cash or the pieces that aren't contingent enough for you to be able to do what you want to do? Because hope's not a great strategy here. You should just assume that within 6 months, you're not really going to love the people that bought your business, even if you're willing to continue to work in it. Because as an entrepreneur, one of the most practical things to think about, and for guys like you and I, David, who work for ourselves, we can relate to this and relate it to clients. For most of our clients, they haven't had a boss in 20, 25, 30 years. They're not going to react well to having some mid-level manager, or worse yet, some arrogant financial guy tell them what to do, right? So the kind of transition, if it involves contingent consideration, should be really thoughtfully kind of mapped out by the seller.
Okay. Well, Kirk, you always give such excellent, comprehensive answers to everything here. So this, again, is prefaced with, if there's anything you haven't already touched upon. But generally, this current market, what sort of impacts upon deals, multiples, and risks for sellers once they get a deal started here? The process, how is the process changing at all here in terms of the mechanics of walking it through, getting a letter of intent, putting yourself out there, and then just trying to make sure the deal gets closed?
Yeah. So there's a few things that have changed, largely to the benefit of sellers. But if the seller isn't already kind of networking in or aware of the M&A community, they wouldn't see these changes. So first of all, the financial sponsors are trying to do more proprietary deal flow, meaning not get business from business brokers or investment bankers. That's so that they can pay less. That doesn't necessarily mean that they're worried about the investment banker or the business broker getting their, consideration. It's that they can convince a seller who's relatively unsophisticated that this is a good deal for you. And we don't need those lawyers and investment bankers to muddy things up. We do deals like this all the time. We're really, really founder friendly. I can tell you that the proliferation of search funds, family offices, and kind of independent sponsors, and even then the big private equity firms, has mushroomed. There are a ton of them. They've all decided that the way to make excess returns is to find these wonderful little recurring revenue businesses that have no cyclicality, no capital expenditure need, and generate 2 million to X million in EBITDA every year that grows like clockwork, that they're going to go find those things and they're going to share the returns with their investors. And every single private equity firm that reaches out to Candor Advisors, and it's multiple per week, is looking for the same deal, right? There's almost no differentiation between them. So there's a ton of them out there. So if you're a seller don't be too thrilled about the fact that you got a ping from some low-level analyst or even a vice president at a private equity firm. They're not a decision maker. They're just fishing for deals, right? Don't give up too much too soon to those guys. Don't tell them a whole lot about your business. Minimally get to a David King. You don't need, Candor Advisors in the initial stages. You just need somebody to tell you how to respond to that unsolicited interest. So if you're a seller, just don't give up too much too soon. Don't provide a whole lot of financial information. Definitely get a confidentiality agreement or non-disclosure agreement in place. That piece should be locked down. And there are plenty of us, whether you're talking to an exit planner, a business broker, an investment banker, an M&A lawyer, there are plenty of us that can caution them on that. Then the other piece is that they're getting much more, the buyers are getting much more clever about, kind of how to come into businesses and how to position themselves with businesses. And so sellers need to armor up. One of the most popular videos, in fact, the two most popular videos in the insights section of Candor Advisors website are that the buyer of your business, if you're a private seller, is a full-time predator and you are part-time prey. I would emphasize that double right now. The more financial sponsor capital that's out there, the more clever they're going to get about their approaches, the more there's a need for transaction advisors, whether they be you, me, you and me, an exit planner and you, just you. Look, the decision about like kind of what to do if you're a seller is good, because demographically speaking, baby boomers and Gen Xers have been a really entrepreneurial generation, and there's a whole bunch of advisors moving to support those folks as they sell businesses. The critical thing if you're a seller is make sure that you're not somebody's first foray or their side venture. Make sure that you're working with somebody who has experience. And I'll use M&A lawyers as an example. We see people that use experienced corporate lawyers who don't have M&A experience to do their deal, or real estate lawyers to be able to button up the contract terms of their deal who don't have M&A experience. They leave hundreds of thousands, maybe millions of dollars on the table by not understanding the issues around risk control and contingent payments and the contract terms around negotiating the net working capital, the formula for an adjusted EBITDA or revenue-based earnout. If you're not working with somebody with M&A experience, you're going to leave money on the table, right? So I kind of went on and on a little bit soapboxy there, but kind of the point is there's lots and lots of resources out there.
Well, people who are shrewd enough to build a business to be successful, whether it's a handful of owners or one, they can usually sniff out someone who's a hoodlum, who's trying to hoodwink them and saying, you don't need an advisor to help you with this. There's a saying Macedonians use that, beauty is a light switch away. And this person is trying to present you with a beautiful deal, because you're never going to see all the bad things about what they're trying to persuade you to do.
You'd be surprised. We've been involved in transactions. In fact, one specific I can think of with a public company where the CEO of a public company not only used more F-bombs than I've ever heard in any conference call in a business setting. It was just shocking. But the other piece is that, his corporate development person referred to me as advisor guy. We don't need advisor guy or any lawyers involved in this deal. We know how to put this deal together. This is a public company buying a 9-figure business. And trying to use their perceived sophistication as a way to tell the seller of the private company, listen, we do this all day long. We do transactions like this all the time. We can kind of coach you along the way. And that is like, taking advice from the proverbial scorpion when you're the toad taking it across the pond.
Right.
Scorpion's going to be a scorpion, all right? Just make your peace with that. And the scorpion's gonna sting, right? So, but if you've never been through it before and you're a business owner and they're waving big numbers in front of you and they're a public company or a huge private equity firm, you don't want to chase them away by bringing in a transaction advisor. And I can guarantee you that you will not chase away any serious buyer by bringing in a transaction advisor, but you will chase away a predator for sure, for sure.
Right. I agree with every word of that, except you would be surprised because I see it daily
Yeah, good point.
myself. Oh, come on, don't ask them. And these relationships have gone so far down the path that it is hard to unwind a lot of these expectations that have been built up on both sides. So, well, Kirk, I really appreciate it. We can hope for the best out there with the economy, but there's plenty to be done. There's plenty of wealth to be created, and it's a good time just to be very careful with the way
Yeah,
deals are put together.
absolutely. Couldn't have said that better.
Okay. Well, you take care, and listeners, thank you for joining us, and we'll see you next time on Selling Your Business with David King.